gold is now becoming monetary infrastructure. In other words, it's just a built-in part of the system that makes the system work, because it's this asset that everybody has to own and that makes everything else easier in the financial sphere. So people are buying gold. That's why it's going up, because we're having this structural shift in the global financial system, and it's nowhere near done yet. I mean, if you think of all the banks that have to diversify their tier one assets, who haven't done it yet, which means they have to buy gold.
Right.
And then the central banks that need gold for the monetary reset that's coming. It's not a surprise when viewed that way that gold is $3,400 an ounce, and that it might be $5,000 an ounce just in the normal course of things in the next 6 months or whatever.
Gold has been the standout performing asset in global financial markets this year. In fact, it has been one of the main talking points around the world for quite some time. For long-term investors, the gains have been just as impressive. Over the last 5 years, the gold price has more than doubled, delivering a compounded annual growth rate, CAGR, of 16%. Even stock market investors will be happy with these returns. Financial analyst John Rubino states the trade war is fueling market volatility, with sudden tariff changes creating emotional short-term swings. In his analysis, Rubino cites a Substack article claiming gold is now the core monetary infrastructure essential for financial stability. He sees a global shift underway, with banks still needing to diversify into gold. He believes this makes gold's major rise towards $5,000 likely soon. Following the market turmoil, John Rubino points to gold's steady climb while the Nasdaq plummeted 500 points, a clear indication of how gold is responding to global instability. Until recently, gold had underperformed equities and most other asset classes for years. However, as equity markets languish, trade wars arise, and macroeconomic uncertainty proliferates, the shiny rock is doing what it does best, acting as a safe haven asset. The old Wall Street adage goes, "There's always a bull market somewhere." In 2025, that bull market exists in gold. Year to date, gold is up more than 28%, outperforming the S&P 500 index by a whopping 42.5%. From a technical standpoint, Rubino explains gold's strength is partly due to Basel III, which reclassified it as a Tier 1 asset. This puts gold on par with cash and bonds, prompting steady, price-insensitive buying by banks. Before diving into John Rubino's sharp insights from his latest interview, hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Well, I think the trade war thing is playing a big role in all the chaos in other markets that we're seeing right now, because nobody knows what to think. You know, the 1 minute they're the Smoot-Hawley tariffs from the 1930s, and they're bringing on the next Great Depression. The next minute, Trump has extended them for 60 days before they go into effect, and then the market is there's an awful lot happening out there in the short-term market movements that have nothing to do with macroeconomics and everything to do with people making decisions under pressure that nobody sees coming. So you kind of have to look past that stuff. Like, for instance, I had a bunch of put options on the Nasdaq and the S&P 500 as insurance, and I got taken out of those right away on that one of those big crashes that we had. And then the market went back up, and I felt smart, and now it's going back down again today. And I wish I still had those put options, but you cannot let short-term fluctuations dictate your mental state. The longer-term stuff is all still in place. So I think it's a lot psychologically more healthy to look at for instance, what's going on with gold. Everything else is crashing or at least gyrating, and gold is steadily going up.
Yeah, absolutely.
Even on days like today, gold was up, $90 an ounce on a day when the Nasdaq was down 500 points. And so that's crazy, except when you think that, gold should be doing this, given all the stuff that's happening in the world. So that's just normal progression. The Basel III thing doesn't get much press, but they named gold a Tier 1 asset, which means it's on a par with dollars and treasury bonds on bank balance sheets, which makes gold much more useful than it used to be for banks and central banks. And so they're buying it steadily, day after day, without being price sensitive. And that's part of what's happening right now. Is I just posted a Substack that posted an article from somebody who went on Twitter with the thesis that gold is now becoming monetary infrastructure. In other words, it's just a built-in part of the system that makes the system work, because it's this asset that everybody has to own and that makes everything else easier in the financial sphere. So people are buying gold. That's why it's going up, because we're having this structural shift in the global financial system, and it's nowhere near done yet. I mean, if you think of all the banks that have to diversify their tier one assets who haven't done it yet, which means they have to buy gold. And then the central banks that need gold for the monetary reset that's coming, it's not a surprise when viewed that way that gold is $3,400 an ounce, and that it might be $5,000 an ounce just in the normal course of things in the next 6 months or whatever.
Regarding the bursting of debt bubbles, John Rubino warns cautions that it creates financial chaos that hits regular people the hardest. Retirees with traditional 60-40 portfolios could see devastating losses if stocks and bonds tank. He also cautions that public pensions, heavily invested in risky assets like private equity and tech, may be far less secure than many assume. Despite market uncertainty, John Rubino notes that gold miners are thriving due to soaring prices, with earnings expected to keep improving. This may attract broader investor interest and spark major moves like mergers or dividend hikes. Mining equities, representing the top 10% of a risk pyramid, offer asymmetric upside as operational efficiencies materialize. A balanced portfolio might allocate 60 to 70% to physical gold cash, 20 to 30% to short-duration treasuries, and 10% to miners, a structure designed to capitalize on sector recovery while mitigating volatility. Many producers were historically undervalued relative to gold, operating with compressed multiples during the bear market. As gold rises, miners' profit margins expand disproportionately, creating what industry experts call the mature phase of the gold market cycle, where equities outperform the metal.
Well, it's terrifying for regular people, because debt bubbles, when they burst, lead to chaos. You know, financial markets go crazy, and housing does things that you never would have expected when they would do when you bought your house. And interest rates either go way up or way down, and you can't tell which ahead of time that they're going to do. And so for the average person who's exposed to all this stuff, it's terrifying and brutal. Like if you've got a 60-40 portfolio for your retirement, you're 69 years old, and you really can't afford a lot of volatility in your assets because you're going to need them in the next 10 years. And interest rates spike, which tanks your bond portfolio. And then the stock market tanks because of higher interest rates, which tanks your stock portfolio, and your 60-40 portfolio goes down across the board by 70%, and you don't get to retire anymore. You know, that's the kind of thing that happens in markets that are probably coming. You know, the specifics might be a little different, but the gist for a lot of people is going to be like that, where the world just goes crazy and it hurts you. And you can't do the things you thought you were going to be able to do back when you thought you were this rich, and now you're only this rich, you know, and then forget about pensions and stuff like that. There's a whole country full of public sector employees who think they have excellent pensions going forward, but those pensions are loaded up on private equity, hedge funds, you know, government bonds, which they think is the safe part of their portfolio, and tech stocks, you know, so they're going to get crushed when the time comes. Where gold is right now is insanely profitable for the big miners, right? They were profitable at $2,000 an ounce US. Now it's twice that. So they're gonna in the fourth quarter they put up pretty good numbers thanks to gold going up. Then gold went up more in the first quarter. So the next set of numbers that come out are going to be even better for the miners. And gold has kept going up since the end of the first quarter. So their second quarter numbers are liable to be even better sequentially than their blowout first quarter numbers. So at some point, the miners have to be discovered by generalist money, right? Because they're going to show up on every earnings momentum chart and radar screen that's out there. And that generalist money is so immense compared to the size of the precious metals mining sector that this could, and the big miners that are raking in the really serious cash will start doing stuff with that cash. So there's going to be a lot of headline news of, you know, Newmont buying some other big miner, you know, creating the biggest gold miner that's ever been conceived of, you know, stuff like that, or, you know, raising their dividend dramatically or buying back insane amounts of stock, because all that cash flow makes stuff like that possible. So I think this is going to be a really interesting stretch for the gold and silver miners if gold and silver hold their current prices. Well, gold's needs to hold its price and silver needs to go up because the gold silver ratio is ridiculous. Silver is too cheap relative to gold.
Traditional safe havens like bonds have performed poorly, pushing capital toward gold and gold miners as an alternative store of value. Expert predictions for gold's ceiling continue to be revised upward as the rally extends. Could this be the moment when gold shifts from an alternative asset to a financial cornerstone? And are you positioned accordingly? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.